Saving money has long been the cornerstone of financial advice. We've been told to stash away cash in savings accounts, believing it's the safest way to secure our future. But what if saving alone is no longer enough? In today's financial landscape, relying solely on savings might mean your money is silently losing value. The key to growing wealth lies in investing, particularly in the stock market. Here's why making the shift from saving to investing is a financial game changer. Inflation is your silent enemy. Let's start with the reality of inflation. Inflation is the gradual rise in prices over time, which means the purchasing power of money decreases. Imagine this. 20 years ago, $1,000 could buy you a lot more than it can today. If inflation averages 3% per year, the value of that $1,000 shrinks by half in roughly 24 years. Now consider savings accounts. While they feel secure, the interest rates they offer are often far below the rate of inflation. For instance, if your savings account yields 1% annually while inflation is at 3%, your real return is -2%. Over time, this erodes your money's value, leaving you with less purchasing power. To put this into perspective, if you save $10,000 today at an annual interest rate of 1%, in 20 years, your account will grow to $12,200. However, due to inflation, that $12,200 might only have the purchasing power of $8,000 in today's terms. This means you're effectively losing money by saving. Let your money work for you. Investing in the stock market offers a way to beat inflation and grow your wealth. Historically, the stock market has delivered an average annual return of about 7 to 10% after adjusting for inflation. Compare this to the 1–2% interest from a savings account, and the difference is striking. Here's an example to illustrate the power of investing. Let's say you invest $10,000 in a diversified stock portfolio with an average annual return of 8%. After 20 years, your investment would grow to approximately $46,010. Contrast this with the $12,200 from a savings account, and it's clear how investing can transform your financial future. Even small, regular investments can add up over time thanks to compound interest. For instance, investing $200 monthly in the stock market at an 8% annual return could grow to nearly $120,000 in 20 years. Saving the same amount in a low-interest account might yield less than $50,000. Wealth creation through investing. Think about some of the most successful individuals and families you know. Chances are they didn't build wealth by hoarding cash. Instead, they invested in stocks, real estate, or businesses. Investing allows your money to grow through market opportunities, unlike savings, which merely preserve what you already have. Consider this relatable scenario. Sarah, a 30-year-old, has $5,000 saved and adds $100 monthly to her savings account, earning 1% interest. By the time she's 50, she'll have just over $30,000. On the other hand, if Sarah invests the same amount in the stock market, with an average annual return of 8%, she'll have over $76,000 at 50. The difference is staggering and underscores the importance of investing. Overcoming the fear of investing. Many people shy away from investing due to fear of loss. It's true that the stock market can be volatile in the short term, with prices rising and falling unpredictably. However, history shows that markets recover and grow over time. The key is to think long-term and diversify your investments. Let's revisit the global financial crisis of 2008. Stock markets worldwide plummeted, causing widespread panic. But investors who stayed the course and continued to invest during the downturn saw their portfolios recover and thrive in subsequent years. For example, the S&P 500 index, a measure of the US stock market, lost nearly 40% in 2008. However, over the next decade, it more than tripled in value. The lesson here is that time in the market is more important than timing the market. Consistency and patience can turn even modest investments into significant wealth over decades. Finding the right balance. While investing is crucial, it doesn't mean you should abandon saving entirely. Savings accounts serve an essential purpose as a safety net. Experts recommend having an emergency fund with 3 to 6 months' worth of expenses in a savings account. This provides financial stability and peace of mind for unexpected situations, like job loss or medical emergencies. However, once your emergency fund is in place, the rest of your money should work for you through investments. It's about finding the right balance. Saving keeps you secure, but investing helps you grow. For example, if you're saving for a short-term goal like a vacation or a down payment on a car, a savings account is appropriate. But for long-term goals like retirement, investing in the stock market is the way to go. The idea of leaving the safety of saving for the uncertainty of investing can feel daunting, but it's a necessary shift for anyone looking to secure their financial future. By understanding the limitations of savings accounts and the immense potential of the stock market, you can make smarter decisions about where to put your money. Something that does help immensely with this search is the use of AI. Check out my video about investing in AI stocks.